how do you feel about interest rate increases and its impact on yield? All right, so there's obviously a lot of impacts, far-reaching impacts across many elements of property or investing in general, but its particular impact on yield. Obviously, investors invest money or resources where there is a return on investment, right? And we have capital growth and we have income associated with property as the ways that we can generate a return. So logic would dictate when interest rates increase, their overall net income decreases, then less investors will be attracted to the market. And that's something that we generally see. And in this, environment, investors might be holding off because 6 months ago they might have been cash flow positive on an investment, and now they're looking at doing the numbers at a particular investment, and it's going to cost them $100 a week to hold that property. So they are pulling back and holding back. But what we're also seeing is a flip side. Less investors in the market, and this happens very quickly. It's a cycle that we see generally takes 2 to 3 months. Less investors in the market, well, what does that result in? Less rental properties available for rent. So think of it as a cycle. There's a property on the market here. That property would usually be bought by owner-occupiers and investors. Let's just say in that suburb area, 50% of properties are owned by investors, 50% of properties are owned by owner-occupiers. So that property that comes onto the market, there's a 50-50 chance it's going to be bought by an investor. If those investors are pulling back and holding back, then it's much more likely that it's going to be purchased by an owner-occupier. And with less buyers in the market, less investors in the market, it's probably going to be for a pretty sharp price, a pretty reasonable price, and that's what we're seeing in Sydney and Melbourne with prices compressing or stagnating. What does that do? Very quickly, there is one less property that's available for rent. So therefore, you have a direct impact, a very quick impact, a matter of weeks, where less rental properties available on the market, vacancy rates drop through the floor. Usually there might be new homes and other alternatives, social housing for people looking for rental properties, but you've got Airbnb nationally now has penetrated through the market, so you have a lot of rental properties taken out of the market anyway. You now have less properties available for rent very, very quickly. Well, what does that do? People shopping around. You have 15 offers to rent the property with great applications on the table before an open home. You have, landlords being able to choose and be very, very fussy with those investors with those tenants that they choose to put into their properties, and we're seeing that across the country at the moment. I saw a headline yesterday about the desperation around people trying to find rental properties at the moment across the country. So very quickly, it doesn't just result in higher quality tenants, it results in high quality tenants who are willing to pay more. Now we deal with this, and this is probably an insider tip, we deal with this every day. Every day here in private advisory, in professional investor land, we are pushing property managers. We are saying, you need to put the rent up on this property because you've got 10 applicants. And they'll come back to us and say, oh, look, we want a good quality, we want a good quality tenant here. And we say, you've got a good quality tenant. You've probably got half a dozen good quality tenants. We want to push the rental up. And then they'll come back to us and say, there's no comparables. How can we justify, charging $450 in this market when the highest other rental is $420? Well, guess what? We push the property managers outside their comfort zone. They generally are very short-sighted. Property managers are usually very good at managing a property, not really around the economics of property investment. So we have to give them a big kick up the bum to push rents forward. Otherwise, they'll just keep rents flatlined. So what we're seeing in the markets that we're investing in is less investors outside of our networks buying. The buying pool is decreasing, less rental properties available for rent. We have extremely low vacancy rates across the country at the moment, less than 1% vacancy rates. Across Australia, it's the lowest in recorded history. So, and then you have a building industry at chronic housing shortages, homelessness at record rates. So these are all combining to the fact of chronic undersupply in the rental market with less investors coming into the market because of interest rate rises. So if you're following me with this argument, and I'm going into a lot of detail here, in the markets that we're buying in, we control the dialogue. You've got to push the property managers because property managers won't increase rents because it makes their job harder. tenants have higher expectations, well, guess what? They're going to be pushing back and calling the property manager more often, so they generally are resistant to increased rents. We have to push them, and we are seeing in these investment-led markets where there are chronic rental shortages, over 2, sometimes over 3% rental increases, not per year, which is traditional, per month. So every month we're seeing interest rates increasing. Well, guess what? We're seeing rents increasing $20 or $30 every single month, month after month in these markets. And we have to keep pushing them. You have to push your property manager to increase rents. So as rents and incomes increase together, guess which one is fully tax deductible at a cost? Interest rates are coming off your taxable incomes. Generally, when they both ships rise together, because of the tax incentives and the tax situations here in Australia, we actually have more dollars in our pockets after tax when we have a high yield and high interest rate environment. And that's the environment that Anna and I were generally buying. The majority of our portfolio was in 7, 8, 9% interest rate environment. Tax time really allowed us to recover a lot of that, and we're seeing this. So for me, it's a positive relationship. It is, yields move with interest rates, and I've seen that over my full, almost 20 years as an investing career. On the flip side to that, we are already seeing, and this is probably straight from the horse's mouth, I guess, in a week, so it was actually meant to be this Thursday, but it's now delayed to early October. I'm having a roundtable discussion with the Treasurer of Tasmania and a senior economist of ANZ Bank Branch, and then I guess I'm the ring-in. I'm the third person on that discussion panel with those two guys with an insight into the banks, the big four, and then also public policy as the Treasurer of Tasmania. And the conversation is around interest rates and inflation, and the conversation or the relationship between the RBA and how they are releasing information, how they are controlling this dialogue, and how much further do we have in this correction cycle for property. And that really is what comes down to it. So that information coming from the senior economist from ANZ Bank Branch, in pre-conversations and snippets from her, it's already revealing. She's seen evidence that Sydney market generally bottoms out with a 10% correction. Okay, and you've got to think psychologically, why is that? When people are investing in the stock market, they are always looking for pullbacks. You have a nice bull run, and they're, a very good stock. The company's going, gangbusters, great management, all of these wonderful things, growth industry, and they are looking for an entry point. You don't buy when the market's ramping up. You wait for a pullback in the market, and then that's your entry point into that market. Well, sophisticated investors in property in Melbourne and Sydney, they think the same way. And the ANZ Bank Branch know this and understand this as well. And that was her comments to me and through the network was, generally you have a lot of people waiting for that magic number. They are waiting for a 10% pullback. And when that is occurred, that is their entry point to launch back into the market. Interest rates, yields, it's all irrelevant when you have good, strong capital growth. And so these sophisticated investors are waiting for that entry point to launch in at that 10% pullback correction. Last check, off the top of my head, I think we're at about 8% pullback in Sydney as a market, a little bit behind that in Melbourne. Is it to say that all markets will pull back by 10%? No, we're talking about Sydney and Melbourne. They are really the backbone of the property industry in Australia. Expect those two big boys to pull back 10%. We have an actively buying in markets that are showing no signs of pullback whatsoever. As yields are increasing, remember, when you strip everything else away, property values are a function of the yield that investment generates. So when yields increase, property values increase, and guess what that does? The yields decrease on the cost base, and this is this never-ending cycle. So in these markets where you have chronic rental shortages, you have rentals going through the roof, parts of rural Queensland, Perth, other capitals, parts of Adelaide, rents are still pushing through the roof 2 to 3%. Guess what? That is returns, and expect growth to follow, because investors chase yield and then values chase yields thereafter.